share my screen and talk about DeFi, myths and facts. And I'm going to actually give this like an institutional investor's perspective. And the reason for this is that I basically have been asked so many times to give advice to major pension plans and endowments all over the world. And I thought it'd be useful to give kind of the questions that they're asking and the sort of questions that I get in this space, because by and large, they're not really in this space yet, but they're seriously considering jumping in. So let's jump into this presentation. So first, what does the agenda look like? I've got a lot of stuff to do. I need to explain to you what decentralized finance actually is and the problems that it solves. And then I'll go through a number of questions and give answers in terms of the myths and facts, and then some other issues that are linked to actually holding these new assets. So what is DeFi? So DeFi is a way to do finance that's peer-to-peer. So currently, we don't have a system like that. So our centralized finance system, you deal with an intermediary, and that might be a bank, it might be a brokerage, and there's multiple levels, multiple steps that you have to go through before you do, let's say, an exchange. So for example, if you buy a stock, it takes at least 2 days to put that stock in your name. And there's multiple levels of bureaucracy behind that. So decentralized finance, and this is an example of decentralized finance, you do a peer-to-peer trade that's enabled by an algorithm. So let's say I've got asset A and I want asset B. So I send asset A to an algorithm and it sends me asset B. And it doesn't matter what time of the day. I can actually see the liquidity in the algorithm. I actually see the code. So it's completely transparent. And then I can also see the price. And the algorithm doesn't care if I'm a buyer or a seller. So this is like very different than what we've got today. And this is very efficient. Decentralized finance is much more than decentralized exchange. So sometimes decentralized exchange is called DEX, D-E-X. But it also has to do with lending, borrowing, tokenization, NFTs, all this stuff, Web3. And I'll talk a little bit about this later. So it's a very broad area. So if you've got a new idea, for it to be viable in the future, it needs to solve problems. So, and indeed needs to solve meaningful problems. So in my book, I detail 5 basic problems. So number 1 is inefficiency, and it's easy to detect inefficiency. So for example, I just gave you an example of to buy a stock in centralized finance, that takes 2 days to get it into your name. In decentralized finance, there's no difference between the execution of a trade and the settlement. It's simultaneously. There's no 2-day delay. And we don't need to go that far to come up with other examples, such as credit card fees, or the cost that it takes to transfer money. So all of these are inefficiency, and this space potentially can mitigate this problem. So number 2 is limited access. 1.7 billion people in the world are unbanked. And to me, that's really unacceptable. In this space, all you need is a mobile phone and you're banked. And And the bank is your mobile phone. There's no centralized bank in the space. So your bank account is on your phone. So all of a sudden, if you've got a mobile phone, you are banked. And there's also limited access, and it's more subtle, but it's really important. And this is especially the case in developed countries, and it has to do with underbanked. So think of a person that is underbanked, which means that they've got a bank account and maybe they've got a credit card. And they go to their bank because they've got a great new entrepreneurial idea. It's very exciting. And they go to the bank and they ask for a loan. The banker likes the idea, but the banker says, I'd rather do business with one large customer rather than 100 people like you. But given that you're part of this bank and you have a credit card, we will provide financing for you in the form of borrowing on your credit card. So that sort of loan is so expensive. It could be 25% annual rate, that it makes this great idea no longer viable. And we need more of these great ideas. We don't need them squashed by our current financial system. Opacity, I will talk about a little later. I've already mentioned decentralized exchange algorithm, completely transparent. Number 4, centralized control. And what do I mean by that? Well, the large banks have very significant market power in both developed and developing countries. So what does that mean? That means that they can charge very high rates for loans and pay out savings rates that are very small. And that is not helpful. This also applies to not just banks, but brokerages, insurance companies, and the government central banks. So central banks largely have a monopoly within a country. And we've seen so many examples of central banks doing things that are not in the best interest of their country and leading to considerable distress. So decentralized finance provides competition to not just the central bank, but the commercial banks and all of the financial institutions. And number 5 is the lack of interoperability. And again, let's say you want to buy some stock from a traditional broker. It could take 2 to 5 days to get money from your bank into the brokerage account for you to do a transaction. In decentralized finance, you connect your wallet and you're ready to go within seconds, not within days. So let's go through some myths and facts, because that's really my presentation today. And number 1 is DeFi is a small part of the market compared to CeFi, centralized finance, and will never overcome CeFi. Now, anytime you see the word never, you always know that it's going to be false, but this one is kind of like fact and a myth. So yes, it is a small part of the market right now. We're 1% into this disruption, but it's unreasonable to say never. And what does overcome CeFi mean? Like, to me, it means more than 50% of finance would be decentralized. And I think that's very credible in the future. So on the far right of the slide, you see some comparables. So the crypto complex right now is over $1 trillion. And that's actually, even though we're 1% in, fairly close to US currency and coins, which is about 2.2 trillion. So even though we're not that far in, it's actually meaningful. And this is an example of a decentralized exchange called Uniswap. They've already done over $1 trillion in transactions. So this, while it's new, while it's 1%, this is definitely meaningful. So number 2, DeFi is difficult to use and will never have widespread adoption. again, this is kind of like a true and a false. Yes, it is difficult to use. And I remember as a junior researcher using the internet before we had browsers, and it was difficult to use. But then it became very easy to use. So it's basically what you expect. At the beginning, it's going to be awkward, and then things improve. So again, the second part with the never just doesn't make any sense. On the far right is an example of my MetaMask wallet, which is the bank that I described a few minutes ago. Cryptocurrency is mainly used for illegal activity. Well, this is a myth. And it is true that early in the life of Bitcoin, it was used for illegal activity. And there's this famous website on the dark web called Silk Road, where you could buy drugs. And everything you'll notice here is priced in Bitcoin. Actually, some of the prices are kind of hilarious today. Notice the 1/8 of an ounce of high quality cannabis for the equivalent today of $40,000. But it is true that early on, cryptos were mainly used for illegal activity. But it's actually difficult to use cryptos for this type of activity. And let me give you a couple of examples here. There was an exchange hack in 2016 where $4.2 billion of Bitcoin was stolen. That was recovered recently. And it turns out that only 80 million of 4.2 billion was laundered over 6 years. And that really speaks of the difficulty of dealing with cryptocurrencies in an illegal way. And look, the overwhelming currency of choice for illegal activity is cash. 80.2% of the value of US currency is in $100 bills. And it is interesting when I ask my students at Duke, how many have a $100 bill in their physical wallet, and nobody puts a hand up. And in the United States, it's very difficult to spend $100 bills. So you go into a store and they'll have a sign saying no $100 bills accepted. And what's going on here? Who's using the $100 bills? Well, this is a picture of the famous drug lord El Chapo. And when they raided his place, you can see the currency of choice was US dollars in the background, some euros also there. But cash is the first choice because it is truly anonymous. Indeed, I show my students this bag that you can buy that is designed to hold exactly $1 million in $100 bills that are used, not new. And also notice that it is sold out. So the Holly. So again, we need to keep this in perspective that it's not the case that criminal activity is exclusively using cryptocurrency. It's a small part of criminal activity. There are certain areas of illegal activity, such as ransomware, where it's much more prevalent to use crypto than anything else. So that is a topic where I've got a recent paper looking at crypto-enabled cybercrime. And that's available for free download on SSRN. Okay, so this is opacity. And I said I would return to it. DeFi refers to a fast-growing and highly opaque corner of the cryptocurrency market. And this is a direct quote from the very powerful senator in the US, Elizabeth Warren, in a letter to the Treasury Secretary, Janet Yellen. So this quote demonstrates that Senator Warren has no idea how DeFi works. Or maybe I should say, perhaps Senator Warren's staff member who might have drafted this letter. So it's really the opposite. So remember I said in decentralized exchange that you can see everything? So it is completely transparent. You see the algorithm, you see the balances, somebody's going to pay you, you see their balance, you see the price, you see the liquidity. Everything is opaque, or not opaque, it's transparent. What's opaque is the current financial system. So the current financial system, when you go to a bank, you don't know how healthy it actually is. You rely upon a regulator to ensure that the bank is safe. But the regulators have a very dubious track record, going back many, many years. And indeed, recently with the global financial crisis, you saw many large banks fail due to risk-taking that wasn't picked up by the regulator. So this is definitely a myth. Here's another one. Government CBDCs, so central bank digital currencies, will put cryptocurrencies out of business. I don't think so. And so to a large degree, the CBDCs are a reaction to crypto because the central banks realized they needed to do something digital to provide some sort of competition to the digital currencies that are crypto enabled. So there's a big difference between a CBDC and a cryptocurrency. And the main difference is the central bank controls the money supply like it always has. And the central bank has the ability to see every single transaction that you make. It's also got the ability to edit your wealth. So basically to say, well, this person, they've got $500,000. We think we should take that away. And it's gone. Okay, so that is far different than the crypto world, where if you've got $500,000, the only way that that leaves your account is if you sign it. So you have the private key and only you can spend it. So do I think that CBDCs are going to take out the cryptos? No. I think we're far away from that. We will have CBDCs and they will be used in certain applications with fiat, but it's not going to be a big competitor to the cryptos. Stablecoins. So stablecoins are a type of cryptocurrency and they are linked to something else. For example, US dollar. And stablecoins are poorly understood because there are different types of stablecoins. You could have a stablecoin that's collateralized with US dollars, and then the dollars are kept in safe assets. You have a stablecoin that's collateralized with crypto assets, and because they're risky, you need to over-collateralize. So it wouldn't be 1 for 1, it might be 1.5 to 1. But there's also algorithmic stablecoins that are not obviously collateralized. So this is an example of a spectacular failure of an algorithmic stablecoin. And this is Terra. So Terra was effectively collateralized with another sister cryptocurrency called Luna. And the idea is that if Terra fell below the peg at $1, then some Luna would be minted to buy the Terra. And in buying the Terra, to drive the price up, back up to par, which would be $1. And all of this completely depends upon Luna having some value. So as people lost confidence in the protocol, the Lunas became less valuable, more had to be minted, and we go into the death spiral. Now, this is a phenomena that you're well acquainted with from traditional finance. So think of a convertible bond. So some people decide to convert into the equity, and some equity is issued. Then the equity is sold, and the selling actually drives the price down of the equity. Then more people convert, and then more equity needs to be created because the price is lower. Then they sell, and then the cycle just continues and drives the equity potentially close to zero. And that's exactly the same thing that happened here. So this is not a lesson from decentralized finance. This is a basic lesson from centralized finance, that if you've got something that's not fully collateralized, then you run the risk of a bank run, or even worse, a death spiral. So here you can see Luna going down in value effectively to zero. So all cryptos are bubbles. There's no fundamental value. I've heard this many, many times. I've got an example of some real bubbles. One characteristic of a bubble is when it's burst, it's gone. So the value is gone. So it is true that some cryptos may be bubbles, but just to use this blanket term for all the cryptos doesn't make any sense. And we've seen these ups and downs, and I'll show you some data on this in a little bit. Don't confuse volatility for a bubble. Cryptos are uncorrelated with markets and provide an inflation hedge. Well, this is a myth. So theoretically, for example, the money supply of Bitcoin is algorithmic. It's not set by a central bank. It's just an algorithm and is well known. So theoretically, that might create a situation where it's uncorrelated with the economy, but it isn't. And the reason is that most of the demand for Bitcoin is by speculative investors. So these cryptos have become, especially since March of 2020, so-called risk-on assets. So that means if there is a crisis going on, like in March 2020, you dump your risky assets, which might be stocks, which might be cryptos. And this creates a correlation. And here you can see the correlation, and you see it jumping in March of 2020. And while it might have been close to zero historically, and this is for Bitcoin in blue, Ether in orange, it's much higher. It's not 1, but I estimate the beta to be about 2. So if the stock market drops by 15%, Bitcoin drops by about 30%. So there is some diversification benefit, but it's not as much as it was in the past. Cryptos are too volatile to be useful. Okay, this is the graph I wanted to show you because people point to the recent drawdown of 70% and say, oh, well, this is the end. But look at the other drawdowns in Bitcoin, minus 61, minus 83, minus 84, minus 70, minus 93. Okay, well, those are really significant drawdowns. And it's exactly what you expect when you've got an asset that's got a 90% annualized volatility. But look in green. Notice the recoveries. So yes, it goes down, but it also goes up. And that's exactly what volatility is. Something is highly volatile. So, and you see similar things with Ether, which has a shorter history than Bitcoin. So what about this idea that they're too volatile to be useful? So this is, again, an insight from traditional finance. So suppose that you're looking to make an investment in the stock market, and it's got 15% volatility, and that's too much for you. That really what you want is 7.5%, so half. So does that mean that you avoid the stock market? Well, no. What you can do, let's say you've got $1,000, you invest 500 in the stock market and 500 in safe assets like treasury bills. And that portfolio has got 7.5% expected volatility. So you mix cash and the risky asset. So you do the same thing with the cryptos. So let's say you're targeting 15% volatility. A crypto's got 90%. So you do the same trick. Got $1,000. You put $200 into the crypto and $800 into the safe asset. So this idea, like too volatile to be useful, it just doesn't make any sense from the point of view of traditional finance. And this is an interesting exercise. I've got a new paper that's referenced at the bottom, and I'll show a QR of the paper download in a few minutes. So what we did in this paper is to look at big moves of the S&P 500 and Bitcoin and Ethereum. And we looked for big moves defined by 3 standard deviations or 4. And we noticed that the S&P 500 had bigger down moves in this sample than the cryptocurrencies. So again, it doesn't make any sense to avoid these just because they're volatile. So there's many other ways to make investment. These are young markets and reasonably, in terms of trading, inefficient at this point. So simple strategies like trend following, which I'm showing in this graph, tends to outperform a simple buy and hold. So that basically means your look back, if it's positive, you're long, and if it's negative, you're short. There's other kind of ways to do this, but I want to talk about custodial issues. So a cryptocurrency is defined by its private key, which is a long random number, 256 bits. You lose your key, then you lost your crypto. The private key, we use that to derive a public address that anybody can see and people can send to your public address, but only you can spend because you've got the private key. So what happens if you lose your key? In this space, there's no equivalent of a password recovery. And this is a story from last year that got attention in the New York Times. And it's a programmer that had some Bitcoin, many different private keys for the Bitcoin, and was kind of concerned keeping this on his computer. If the computer was hacked, then he would lose the private keys. So he thought of a different idea. It's called a hardware wallet. It's not connected to the internet. You load up all your private keys, and it's very convenient because it's password protected. So you got one password, and that is protecting all of your keys. So the problem is that the programmer forgot the password. And the way that these hardware wallets work is that you get 10 tries. On the 10th unsuccessful password try, then the hardware self-destructs. There's no way to recover any data. The programmer has tried 8 times with no success. In the wallet is $240 million of Bitcoin. So you can see that this is an issue, but this issue has been substantially mitigated because you've got the opportunity to delegate a custody to a trusted institution like Fidelity or an exchange. So that ability exists today. Let me also show you, this is a good one. Somebody's being interviewed on a TV show and asked to, what does this private key actually look like? And they pull out of their wallet basically a gift card with a private key on it. And then somebody watching the TV show scanned the QR and instantly spent that Bitcoin. So you don't show your private key to anybody, because if you do, you could lose your cryptocurrency. Okay, so what about regulatory issues? And this is really challenging because we don't really have regulation yet for cryptos. And it's difficult for the regulator because if they do nothing, then people will be taken advantage of. But if they do things that are really harsh, then ideas just move offshore. So instead of locating in your country, locate in the Cayman Islands, for example. And no country wants to lose their best ideas. So that's what I mean by balancing act. You need to get it in the middle somewhere. And the regulators are very much aware of this. But their job is made so difficult because this technology is difficult to master. And even after you put all the time in to actually go through and learn about the state of crypto today, even after you do that, the depreciation is so substantial. This space is evolving very quickly. So you need to constantly be investing in your human capital. And it's hard to do that when you've got this other full-time job. So for me as a teacher, I also face this. So last year, when I taught my course, or earlier this year, when I taught my course, almost all the slides that I showed were new. So over 75% were new. And that gives you an idea of the turnover in this space. The other issue is kind of obvious, that to hire new people at the regulatory agency that have knowledge in this space is difficult because they've got other opportunities. This is the US Securities Act of 1933. And I show this because by reading this act, it's immediate that it's not equipped to deal with this new space. And indeed, if something is designated as a security within the Securities Act, it requires a transfer agent, and there's no transfer agents in decentralized finance. Remember, it's peer-to-peer. So this act is just not appropriate to the particular issue at hand. So, let me also kind of warn of kind of the obvious thing, that if you're thinking about getting into this space, you also need to make the investment to understand what you're investing in. And it might seem obvious to us, but for many people, they see like a double or triple digit guaranteed return. And for academics and finance, anything like that is not guaranteed. It just screams risk. Okay, so what is specific advice that I give to these very large asset managers, endowments, and pensions? And I think I've talked to about $16 trillion worth to date. So number one thing, you need to have somebody in charge. So you need a head of digital assets. And I see so many companies make the mistake, they hobble together a committee of people that have other jobs with no obvious leadership, and they dabble. No, you need a strategy. And again, only invest in things that you understand. And then the basic advice that you give in Finance 101, have a diversified portfolio. So to have crypto in your portfolio just by buying Bitcoin, that's like having stocks in your portfolio and just buying a single stock. That's not good enough. So the way that people get exposure, number one, invest in a crypto venture capitalist like Paradigm. And they have incredible skill, but you pay for it. So it's like 2% of the capital you put in per year, and then 20% of the upside, as an example. So so-called 2 and 20. But there's other possibilities here. And this is a very diverse space. So you could invest directly in so-called layer 1 tokens like Bitcoin and Ethereum, Solana. You can invest in governance tokens, which are kind of like buying equity in a protocol. You could invest in the private equity of startups. And it's also possible to do something new that's called staking, where you put some capital up and you earn a rate of return in doing that. And it's kind of analogous to risky fixed income. So I mentioned Paradigm, and this is an example of their portfolio. So many institutional investors will just take a look at this portfolio and say, well, Paradigm's invested in these names. We don't know the weights, but maybe we should replicate this portfolio as best we can, at least the names. The other thing that I want you to take a look at is the diversity. Notice on the far right, you see L1, which means layer 1. So that's like Bitcoin and Ethereum. But look at the other stuff here. There's so many different places in this market: Web3, privacy, data analytics, financial services, infrastructure, layer 2. Layer 2 are technologies that make layer 1 go faster. Indeed, I've got a list in this paper that I'll show the QR of 20 different parts of this space. It is so diverse. And again, just to bet on one of the 20 is probably not what you want to do. So this is kind of an interesting one, because sometimes these investors come to me and say, well, I appreciated your presentation. You know, we've met as an investment committee and we've decided that we want zero exposure to crypto. So we think it's too complex, it's too early, it's like too much risk of criminal activity. And we have consciously decided to have zero exposure. And what I say to them is that there's an alternative way to think about your positioning, that you don't have zero exposure, you've got negative exposure. Because many of the companies, the names in your portfolio, are at risk because of this disruption. For example, you hold banks in your portfolio. Well, they're at risk. They might not go away, but their business model is going to fundamentally change. So I'm okay with people saying, well, we don't want exposure to this space. That's just like an investment decision. And I assume it's well thought through. I wouldn't necessarily agree with it, but I respect that decision. But you need to understand that even though you're not participating directly in the space, you have negative exposure, negative beta to the space. So you need to realize that. Okay. So my vision of the future is much different than what we have today. So we will have efficiency, we'll have security in our transactions. Consumers will greatly benefit from this. The people that are losers are all the middle people. So back office jobs and things like that. But it's better for those middle people to be redeployed to something much more productive. So I think that's all good for the economy, I see a world with near zero transactions costs. That will create new assets. It will eliminate subscriptions. You pay for everything in real time. All assets, virtual or physical, will be tokenized. So think of stocks being tokenized, bonds, mortgages, commodities. And this offers so many possibilities. So it means that we've got different ways to transact. Go to your store and you buy something, and usually you would use the fiat currency to pay. But now you pull your phone out and you choose what you want to pay in. Maybe you want to pay in gold, and you just hit the gold. And maybe the store doesn't want gold, they want silver. And seamlessly, you go to a decentralized exchange, and the best possible swap between gold and silver happens, and the store gets paid with what they want. Okay, so basically, there's no longer a monopoly on the fiat currency, many different ways to hold value. This is a technology of financial democracy and a technology of financial inclusion. So within decentralized finance, everybody's a peer. There's no banker and customer. There's no retail investor, institutional investor. Everybody is a peer and treated equally. So I believe that we are in the midst of a bottom-up rebuild of our financial system, not a renovation. This is definitely not a renovation. This is a rebuild. But in any situation like this, with any technological revolution, there's always bumps in the road. And we've seen this before. And there will be more bumps in the road. I can guarantee that, especially when you've got very high volatility. So this is something that should be expected, but what we need to do is to focus on what the benefits are. There will always be costs associated with those benefits. It's always the case. So this is my book and my address and things like that. And I really look forward to your questions. And this is the QR that I mentioned. And the conference can share this. It's called an investor's guide to crypto. So at this point, I'm going to stop the share and more than willing to take some questions.
Dr. Harvey, thank you so much. Go ahead, sorry, I interrupted you.
Yeah, no, you can raise hand if you want. That's a possibility. Or you can put questions in the chat box. So I do see one question in the chat box. So it says, for DeFi and due to the absence of KYC, what are the methods of payment and insurance available to the DeFi platform in addition to over-collateralization method? Okay, so there's a number of issues in this question. So the issue of KYC. It is true that this is much easier to enforce in centralized finance. And this is maybe one of the downsides of crypto in that you can operate privately. But this is not just a crypto issue. This is an issue for kind of private messaging, private telephone, private video, that you allow some bad actors to communicate with these technologies. And that is the downside. So again, what we need to do is to balance the upside and the downside. There are some DeFi protocols that are kind of a mixture of DeFi and some centralization. where you need to be whitelisted before you can do business on the protocol. And this kind of raises an interesting possibility. I'm not like a DeFi evangelist or a crypto evangelist. And indeed, if you read my book, you'll see that a substantial part of the book is devoted to the risks. And some of these risks are unique. So I'm a finance person. We talk about expected return. We talk about risk also. So there's definite risks. And indeed, at the end of my presentation, I was pretty clear that there are risks here. Okay, so again, with the new technology, there will be risks. If you want to eliminate all those risks, then just invest in treasury bills and be satisfied with like a 1 or 2% annual return. Okay, so in my vision of the future, it's not 100% DeFi and 0% CeFi, and it's certainly not 100% CeFi and 0 DeFi. It's a continuum. There's certain things that can be done more efficiently in a centralized manner. So for example, credit. There's no credit in DeFi. Mm-hmm. Everything is either fully or over collateralized. So credit, you need trust. So I think that that is like some room, some availability for kind of centralized financial institutions. They'll look different in the future, but there are certain functions that don't work as well or are very underdeveloped in this space. So yeah, this issue of the collateralization, there are, for example, centralized stable coins that are dealing with this because they need to be transparent. So Circles USDC is kind of the leader here in transparency. You can see exactly what is being held. US Treasury bills, very low risk. The crypto collateralized stablecoins, you've got instant transparency. So you can see in real time exactly what the collateralization ratios are. So it's like there's no doubt that it's true. So once it's in a blockchain construct, you can't change the data. So you've got a level of transparency like we've never had. So again, that's really important. I mentioned the algorithmic stablecoins. I think they're very, very challenged. That maybe there's a possibility of a slight under collateralization with an algorithmic sort of money supply rule, but to have your collateralization based upon like a sister crypto, that's just not going to work. Okay, and I'm looking, I don't see any hands that are up.
There is one hand up.
Oh, I don't see that.
Mohammed?
Oh, there it is. Oh, Mohammed. Yeah, okay, very good.
Yeah, first of all, thank you so much for the great presentation, Professor Campbell. I really appreciate that. And just to elaborate more about the question that I just asked. So basically, if I went to a DeFi asking for a loan, the current available methods so far is that I already got this money and I'm asking for more, like yes. Just as you just mentioned, the collateralization.
Yeah. So, right. Yeah, so again, let's think about this. So the way it works right now is like a mortgage or a home improvement loan, that you actually have the house, you've got the value, and you need some money for something else. So you go to the bank and you pledge your house to the bank. So the bank now owns your house, and then the bank gives you a loan. It is over collateralized. Okay, and sometimes severely over collateralized, because the house is worth far more than the loan. So that's basically the way traditional finance works, and with over collateralization. And it's kind of like the same thing. Like, of course, you could sell your house, and then you can take whatever money to pay for what you want, but then you don't have a house. And you think maybe your house is going to go up in value. It's kind of the same thing with crypto, that you don't want to sell your crypto, but you need some liquidity and you borrow based upon that. So this is over collateralized borrowing, which is a very substantial part of our financial system. And I think where you're going is, well, I don't have the collateral, or I've got limited collateral and I need a loan. And that's not a place for crypto or DeFi. So that is a place where maybe you could go to a traditional financial institution. They know you, they've done research on your job, how much money you're making, and things like that. And maybe they will post the collateral and you could get a crypto-based loan. But this under collateralized loans or no collateralized loans, that doesn't happen in crypto. And there's only one exception to it. And if I've got a little time, I'll talk about that exception. So Nada? You need to unmute.
Nada, you can unmute yourself and okay, maybe she has
Yes,
there.
sorry,
Unmuted
it
now.
showed that the host was didn't allow unmute. So first of all, thank you so much for this wonderful presentation. Second, I have a quick question regarding, do you think that like some people might be against the idea of like decentralizing finance, because some people are actually like benefiting from making arbitrage profits, and this way is just much more transparent and much more efficient? So they may be against it because it would like destroy their idea of like arbitrage profit making.
Yes. So there's a lot of people that stand to lose from this. So you think of, and this is like a much, like we're talking about like the finance aspect of this, but to be clear, this covers all of Web3. So there's no Web3 without DeFi. And Web3 has much bigger ambitions. So we already have kind of decentralized Wi-Fi, but we'll have decentralized telephone service, decentralized many things. So decentralized music, decentralized social media, decentralized delivery systems, decentralized equivalent of car sharing. So all of this stuff is enabled by decentralized finance. And just kind of going through that list, you could put like the big names that are associated with this kind of being disrupted. So this is very significant. Yes, of course, there are many people that stand to lose, and they're almost all the middle people. And again, I think it's better that we have an economy that's more efficient. You reduce the frictions, and this is related to much of my academic research. You reduce the frictions, then you have the chance of higher economic growth. Okay, so think of that example I gave you with the entrepreneur. They've got a project that is really a good idea, 20% return potentially, but they can't do it because the cost of borrowing is so high, 20%. So if we reduce the friction and that cost goes down, then the project's pursued. That increases economic growth, that increases investment, increases employment, and we've got a credible chance to actually boost our growth, our real growth. I believe that the space could enable the type of growth of 5 to 8% real growth per year. And we don't have that right now because of all these frictions. So yes, there's a lot of people that make their business in traditional finance that will be losers. Just so think about this, where you do like a wire transfer might take 2 to 5 days to go through. Where's that money go? Somebody is actually making money off of this. Or why does it take 2 days for a stock to settle? Well, there's multiple layers of middle people that are making money. So we need to expunge that middle layer, in my opinion. So given that you mentioned arbitrage and given that I've only got 3 more minutes to go, let me tell you how arbitrage works in decentralized finance. And it's a nice way to end off. So I will explain the idea of a flash loan. So this is a concept that is unique to decentralized finance. And one key thing to understand in decentralized finance, that a transaction might have many steps, and all steps need to go through before the transaction is valid. So suppose you see on one exchange, a token is relatively cheap, and the same token on another exchange is more expensive. That's arbitrage opportunity. So the first step, you take out a loan, totally uncollateralized.
Mhm.
The second step, you buy the cheap token. The third step, you sell the same token on a different exchange at the higher price. Step number 4, you pay back your loan. And step number 5, you actually record a profit. So this flash loan, it's called a flash loan. It's completely uncollateralized. It's got 0 duration. It's got 0 interest, and there's no credit risk. And let me tell you why there's no credit risk. Suppose step 2, you buy the coin cheaply. Step 3, by the time you sell it, the price has fallen. So you take a loss. Step 4, you can't pay back the loan, which means the entire transaction is canceled. It's as if you didn't even take the loan out. So this is a key insight into decentralized finance. First, it's very interoperable. So one exchange, buy in one exchange, sell on the other, and it's like instant to do. But this is the key thing. And I show my students examples of these flash loans. It could be the flash loan is like $1 billion, completely uncollateralized. And you think about, well, who could do an uncollateralized loan for like $1 billion? Even the biggest hedge funds in the world, there's no way they could do it, no way. But this could be your daughter in high school sees the arbitrage. She has no capital, and she executes this arbitrage. Okay, so this is also what I mean by financial democracy. Arbitrage used to be focused on like hedge funds and high frequency traders and things like that. No, this is available to anyone. And this interoperability and the ability to transact very efficiently is much different than what we got in traditional finance. So let me end off by just one thing. In my vision of the world, my book actually starts with the sentence, "We've come full circle." And what I mean by that is the original market exchange was decentralized. It was peer-to-peer. It was called the barter method. And that was very inefficient because you had to exactly match people. Then we introduced money, and market exchange became more efficient. And now, with decentralized finance, we've got the possibility of going back to barter, but in a much more efficient way. And the last thing I will say is I've made the statement that in 20 years, people will look back at fiat inflation as a historical curiosity. And the insight here is there's so many different ways to hold value, and they could be real assets, that it doesn't matter what your government is doing, you can be hedged because you've got US dollars, you've got gold, whatever you want, land. You've got a diversified portfolio that you can use to transact. So it's a very exciting space, and I really appreciate you inviting me.
Dr. Harvey, thank you so much. That was excellent, very informative. We really learned a lot, and I'm so excited to read the book and learn more. Thank you so much for your time.
Okay, well, thank you again. Okay.
And thank
Bye.
you for the audience for your participation.
Yes,
Thank you
excellent
so much.
questions.
Okay, bye.